So that brings us to an introduction to dividend tax. Dividend tax will go live on the 1st of April. It's not an April Fool's joke. The legislation was signed off before New Year. We have got 3 months notice that it's coming, but at this stage we don't have the forms. And we've got to look at it and put it all in context and see what it's about, what we can leave for the nerds, the researchers, and the board exam candidates, and what is actually substantial in our lives. This will take about 45 minutes to get through. Currently we have STC. And the first question must be, why change? It's taken us 20 years to learn how to use it and abuse it. And now we want to change all the rules just for why. And there needs to be a whole history in this thing. One has to first of all put it in context as to how big it actually is. This is a graph I'm going to use over and over again this morning to illustrate the problems of South Africa. 36% of taxes come from the individual taxpayer, 252 billion rands a year, and that is followed straight away by VAT, 28% of total taxes. So before you even start, the individual is paying about over 60% just in the first 2 taxes. Corporate tax has declined for 2 reasons. One is that profits are not so good post the global credit crunch, and the other is the drop of the tax rate to 28%. That we can talk about maybe in a little bit more detail later. Then they go back to the individual and they clobber them with customs and excise duties and sin tax. If that's not enough, fuel tax. And then only do we come to STC, currently collecting 18 billion rands a year. And it will probably decline to 10 billion rands a year once dividend tax is in, because of the exemptions that are in dividend tax that are not in the current STC system. So when you talk about 10 billion, we can get that, that's the equivalent of cigarette taxes, okay? It's not a major thing. It's failed plenty of board exam students because it's nice and complicated. One often thinks, why should we bother? And then there are the other little taxes, cedar levies, transfer duties, and the like, which make up the rest of the pie, but they're pretty insignificant. So it isn't the greatest tax, and it's going to get even smaller, but now we have to revise the whole thing. Why? Well, let's go back into the history of dividend tax. And we see that years ago, in fact, I was the last student who had to endure the partial taxation of dividends and undistributed profits tax. If you could pass the board exam question in that year, you could call yourself a chartered accountant. It was demented. And not even SARS officials could get it right all the time. Everybody failed that one. That was so complicated that the Minister of Finance in the closing years of the new South Africa, Barent du Plessis, he couldn't understand it either. So he said, fucked it, and he somehow deleted it out of the Tax Act, okay? And we lived without a dividend tax for a couple of years. But that was not sustainable from a couple of points of view. One is it drove up the corporate tax rate. 2, it encouraged the distribution of cash out of companies because there was no cost to removing cash from companies. And 3, it wasn't politically sustainable to be saying, well, let's just let the wealthy off the tax on their dividends, even though you had a 35% corporate tax rate. So it was a bit controversial, that. So we got to the new South Africa, and Barent du Plessis, remember, retired hurt after his fight with J. Naidu over the implementation of value-added tax. Once VAT was in, Barent said, fuck this for a lock, and he was out of the door, and we got the new Minister of Finance, Derek Keys. He was head of GenCo at the time, didn't have much better else to do, so he came in as Minister of Finance, and he dealt with it by bringing in the implementation of STC in 1993. The very first thing that you learn from it is the desire to recover your dividend tax, not from all the shareholders, but from the company. They don't want to chase everybody down, as they did with the partial taxation of dividends. And in that respect, STC has worked. But there is an inherent flaw in STC. And this is what causes the change. STC is a tax charge on a company, not the shareholder. So it hits your earnings per share. And for the individual investor, whether he pays the tax in the company or the tax in his own name really doesn't make much consequence, but it has an enormous consequence for the international investor. Because the international investor says, hang on, what you've got is a situation where you take 100 Rand revenue profit, less 28 corporate tax, 72 distributable, but if I distribute, I pay 6.6 STC, leaving me with an effective tax rate in South Africa for a foreign investor of 34.6%. And then they say, once I get the dividend home, it cannot be credited in a dividends tax computation abroad, because it's a tax on the company, not a tax on the shareholder. So it's not recognized overseas. It's only otherwise seen in Estonia and India. It's a very rare form of tax, this. And it is not recognized in terms of any of the double taxation agreements. So they don't like that, and they start jumping up and down. Now, you will remember that this was looked at in 2007 when Mbeki was still in power. And Mbeki and Manuel were hell-bent on impressing the international investor. They were probably more hell-bent on the international investor than they were on the local investor. So they said, okay, we'll change it. And what the overseas investor wants is to say 100 Rand revenue profit, less the tax, 72, distribute but no tax on the company, take 72 to the shareholder, but then impose a dividend tax on the shareholder, which can then be recognized in terms of double taxation agreements and used in the dividend tax imputation computation. So it's very much something that is driven by the international investor. Other criticisms on STC is that we have problems in an intergroup situation where we declare a dividend from subsidiary to holding company. That can only be exempt if we're in the same group of companies as recognized in Section 41, i.e. a 70% shareholding, and we comply with Section 64B5, which says inter alia that the dividend's got to be paid out of post-acquisition profits. There's got to be a notification of SARS, etc. So let's say the intergroup position on STC is a little bit cumbersome. But the biggest change comes on retirement funds, and this I'm going to go on and on about. Because currently STC makes no inquiry as to the shareholder. It taxes indiscriminately. So where we go from company to retirement fund, there's STC implemented, no exemption. And they're saying, but we're trying to get South Africans to invest in a tax haven called a retirement fund, and yet we still have a form of retirement funds tax because we have STC on dividends. So you have the rather ridiculous situation that a retirement fund receiving interest, it's tax-free. Receiving a capital gain, it's tax-free. But receiving a dividend, it's paying an underlying tax. So they need to do something about that. And that's probably the biggest change as affects the individual shareholder in South Africa. Right. STC's current provisions are driven by the definition of dividend contained in Section 1 of the Act. Those of you who wrote the board pre-2011 remember that that was driven by what are the reserves of the company. We always used to joke that whoever wrote that definition had a tormented mind. Okay? Very complicated, looking at pre-1993 revenue reserves, post 2001 capital reserves, and all sorts of crazy stuff going on in it. That was your definition of dividend, which drove your charging provision in STC Section 64B. And then your deeming provision was contained in Section 64C. They couldn't wait to get rid of the definition of dividend. So the old definition of dividend stepped aside as being antiquated and was replaced 1 January 2011. So that's already done. We'll revisit it in this lecture and have another look at it. Then, with effect from 1 April 2012, we replace the charging provision and the deeming provision with new provisions from Section 64D onwards. So that's what we're now out to do. We go straight past Section 64D because that contains the definitions for purposes of dividend tax, and the charge is then levied in terms of Section 64E. you will see that 64B and C will have to remain there for a little while. Right. So 64E says there must be levied for the National Revenue Fund a tax to be known as dividend tax, to be calculated at the rate of 10% on the amount of any dividend paid by any company other than an international headquarter company. So that's great. That's nice and simple, straightforward charging provision. But the moment that you have to have a charging provision, you have to say, wait, there's something more to it. We have to say, what is the timing of the tax? When is a dividend deemed to be paid? And that's where they say, right, for purposes of this part, a dividend is deemed to be paid not on receipt or accrual, on the date on which the dividend is paid or becomes payable by the company that declared the dividend. Nice simple stuff in the first two charging provisions. So we say, right, we'll pay 10% over when we pay the dividend, or it's payable or claimable by the shareholder. So it's a simple 10% tax, and the problem now, we can start going into the nitty-gritty and getting clever. What is a dividend? And that's where you have to go back to the definitions which are contained in section 64D. So 64D, what's a dividend? A dividend means any dividend or foreign dividend. Wait. Notice they're treating dividends and foreign dividends the same. That's going to come up this morning a few times because in the past we did not have that concession. Remember, foreign dividends used to be fully taxable, and that's going to change. But we'll come back to that later, more about that later. So it's any dividend or foreign dividend paid by a company that is resident. And for most practicing CAs, the dividend definition stops there. For the nerds and CA candidates, it then continues. Or paid by a company that is not resident, if the share in respect of the foreign dividend is paid is a listed share, to the extent that the foreign dividend does not consist of an asset in specie. So the three blocks to the right there, unless you're dealing with foreign companies, you can go Control-Alt-Delete and you can just stay with paragraph A. It's nice and easy. But they still don't know what is a dividend. It just says a dividend is a dividend paid by a company that is resident. That's why it does a hospital pass now, and it says jump from D to section 1 to find out what a dividend is. We've basically got the charging provision thus far, but D was no use to us because it simply referred us back to section 1 as to what is the dividend. And this is where it gets a lot simpler than the old definition of dividend. We've now had for a year the new definition of dividend contained in section 1. And that says we have a general charging provision, which says it means any amount transferred or applied, not received or accrued, by a company that is resident for the benefit or on behalf of or in respect of any share in that company. Nice and simple, and then it extends it just a little bit, where it says, right, take that and extend it by way of distribution or by way as the consideration of for any share in that company. Simplify that down then to a routine dividend and a share buyback. Those are the two things that fall in the definition of dividend. So that's it. Then we come to the exclusions after that. Now when we come to the exclusions, note they are the exclusions from the definition of dividend. That's one set of exclusions. We will later have the exemptions from dividend tax. That's another issue. So now we have to say, right, what do we exclude? We exclude the reduction of contributed tax capital, where we have the shares in a company or where we have the repurchase of securities. Items 2 and 3 are not that common. The most common one in practice is the reduction in contributed tax capital. So what we have to do now is we have to go and say, right, it's 3 items that we've got there. That's return of share capital, share repurchase, and securities repurchase. We now need to go in there and say, what is contributed tax capital? And contributed tax capital starts to get a little bit hairy.